Hi, my name is Christopher Terry, CEO of iMarkets Live, and I want to welcome you to our webinar about Forex and futures. Before we get started, I want to get a little groundwork. I'm going to open up a screen, and this is going to show a YouTube video. Now, right at the bottom right of your screen where it says Settings, click on that, either go to HD or Auto, and then reset the video back to the beginning. When you do that, it's going to update the video to have a very clear picture. The other thing you want to do is click on this button right here and make it full screen, and that way you have the crispest, clearest picture and you can see the video as best as possible. Let's get ready. My name is Christopher Terry. The idea of iMarkets Live came from over 14 years of retailing my educational services and mentorship in partnership with other expert traders. This produced some of the most successful and recognized traders and analysts throughout the world. iMarkets Live is a system of products which now allows virtually everyone to become a successful trader. I'm living proof that there is a better way than what you are doing right now to create real wealth. I feel blessed to be able to bring to you these products and opportunity to meaningfully change your life for the good by merging of two powerful industries. A little bit about myself, and then we're going to proceed and go through the webinar on Forex and futures, but it's important for us to let you know who's educating you. My name is Christopher Terry, as I said earlier, and I've spoken for numerous derivative conferences, private events. I've been in numerous magazines. I'm asked to speak throughout the world. I've traveled to many, many different countries educating. I've been in books and magazines, and it's my blessing to be able to share this and help educate others. I've been interviewed for big websites such as Optionetics, written articles from magazines. Some of them have been put into books as chapters. On the back of our website, inside for our members for iMarkets Live, we have multiple articles that I've written for various magazines. I've been in numerous books of people that I have mentored, and also people that are in the industry that had asked me to give a quote or had cited some of our work. Here's a book by Adam Grimes, a friend, The Art and Science of Technical Analysis, and he included me in his book along with a lot of big market wizards, people with major names in the industry, and I was fortunate enough to be put into the book with him. There's another gentleman by the name of Brett Steenberger. He's a phenomenal educator, psychologist in the markets, and very well respected doctor. In his book, Enhancing Trader Performance, he had asked me to do a quote for him. In the book, Trading Full Circle by J.U., who is a former competitor of mine, he asked me to give a quote when I was back with my old company. There was a book written and published by Bloomberg by two people, and they had cited some of my work, which is basically coming out of the Stocks and Commodities magazine. So they had included in their book. I've written 2 chapters for multiple books, and this one was called The Dow Theory, and it was in a book from SFO called Technical Analysis. And they produced a second book on the psychology of trading, and I put an article which became a chapter in the book, Defining the Trading Game. And last but not least, we have partnered up on the educational side with one of the largest educational platforms, brokerages in the planet, Ninja Trader, and we're part of the ecosystem. And at the time of this taping, this is a recent press release. Basically, they are excited as we are that we've joined hands in educating people about becoming traders. And as you can see here, we have a lot of information that we do, and it's just absolute blessing to be able to bring to the public through Ninja Trader and iMarkets Live our educational services. And let's get on to the webinar of Forex and Futures. In this webinar, Forex and Futures, we're basically going to introduce to you the Forex and Futures market. All the information you're going to need to proceed to the next step. Now, at the end of the video, we're going to teach you a pattern, a high probability pattern that I've used for the past 2 decades. One of the most incredible patterns that ever exists in the trading industry is based on pure technical analysis. But before we get to that, let's go through the markets. And again, my name is Christopher Terry, and we're iMarkets Live. Simple risk disclosure, basically saying that Forex and Futures has large potential rewards and it also has potential risk. And don't trade with money you don't have. Now, what is trading Forex and Futures? Trading, unlike investing, a trader can make profits when prices rise and fall. An investor can only make profits when prices rise. We trade, we do not invest. We do not give investment advice. We do not trade for any individuals. We provide educational services only. We do not direct or give specific advice to anyone's particular trading account. We do not earn any commissions from any brokers, nor do we have any relationships with any brokers whatsoever. We do not charge a performance fee. An addendum to that is we do have an educational relationship with a particular broker who provides their platform. As we had said, it was Ninja Trader, but we have zero broker relationship. Forex. What is Forex? Have you ever been to another country? Have you ever traveled and you see the kiosks in the airports and it says currency exchange? And the currency exchange means that you're selling your currency and buying the currency of another country. For instance, if you're in the United States and you're going to England, as you see on the chart here, you're going to sell your dollars and buy British pounds, the same as if you were going to Japan. You would sell your dollars and buy Japanese yen. So essentially, Forex or foreign exchange or Forex or currencies is the exchange of one country's currency for another country's currency. The great thing about this market is it operates 24 hours per day, and it's the largest market in the world at $6 trillion a day. Now, although money operates 24 hours a day, 7 days a week, for the purposes of trading, it's open from Sunday night at 6 p.m. Eastern Time until the following Friday at 5 p.m. Eastern Time, 24 hours a day. It does not operate from Friday night from 5 p.m. to Sunday night till 6 p.m. on the weekend. Now, the major currencies that we trade are the United States dollar, the USD, the EUR, Euro, the JPY, which is the Japanese yen, the AUD, and that's the Australian dollar, the New Zealand dollar, which is NZD, the British pound, which is GBP, and the CHF, which is the Swiss franc. And we also trade the Canadian dollar, CAD. Now, the major currencies are 75% of the whole world's currency exchange, where there's minor currencies like the Singapore or Mexican pesos, but 75% are controlled of the major currencies. And the USD, the US dollar, makes up 75% of all currencies. The major currencies are paired with the US dollar or crossed with one another. So if you're looking at this particular screen right here, you see EURUSD or USD CAD or GBP USD, that's considered a pair. Everything's paired with the US dollar, but yet when the GBP or British pound and the Japanese yen are paired, they're considered crossed, and they basically have their own rates, but everything's surrounded around the US dollar. And here's a particular chart. Isn't that a beautiful picture? So in this example, this chart, on the left, you're going to see many different currency pairs and also crosses. So where you have the US dollar paired with the EUR USD, and the GBP is now crossed with the AUD, which is the Australian dollar. The major currencies, once again, are the GBP, AUD, CAD, CHF, New Zealand dollar, Japanese yen, euro, and USD, and they're crossed and paired together to create 30 tradable symbols, which is around a $6 trillion a day trading. So we consider this Forex, FX, or foreign exchange once again, and as I said, 75 to 80% of all of these control all the different markets. And I have this different charts showing you what it looks like. So to calculate the market value, the market's based on 100,000 units of currency in what they consider a standard lot. Now they have a mini lot, which is based on 10,000 units, and we'll get to that in a moment. So for example, the USD pairs are based on $100,000 and the margin's 2,000. Where the euro, which is stronger, is 100,000 units of euro, and that's based on $1.36, is $136,000. So essentially everything's based on 100,000 for the standard lot, and the margins are 2%. The margin of 2% controls 100,000 units or a 50-to-1 leverage. What is great is on the standard lot, the pip value is $10. What that means is percentage in points is when the market moves from 10933.1 to 10932, that's a $10 change. And the same here, 95.18 to 95.19. Now, they have a mini lot, and that's based on 10% of the standard lot, and it's dollar per pip movement, and the margins are 10%. So instead of $2,000, it's only $200, and instead of $3,200 to $3,500, it's $320 to $350 to leverage 10,000. And they have a smaller denomination called a micro, which is 10 cents per pip, and you're controlling 1,000 lots for those who want to get into the markets at a very small level. So the margins would only be $20 or to $35. So the Forex markets allow anybody from any wealth or net worth to come into the markets, whether it's the small guy or the very large player. The Forex market does not have a central exchange or a central location. It's a seamless flow of trading through a network of banks over a 24-hour period, 5 days a week. It goes from Sydney, Australia to Tokyo to London to New York and around the world from bank to bank to bank. There's no central exchange. Individuals like yourself and myself have the same access to trade the Forex markets just like the major banks, hedge funds, insurance companies, major public and private companies, money and hedge fund managers. So JP Morgan or Goldman Sachs or Citibank or any of these big companies, these insurance companies, we have the same ability as they do to enter into the same price as they do. It's the most liquid market and most volatile market to trade. It's a favored market among traders. The leverage and margin is amazing. In the spot market is what we just discussed. This offers 2% margin or a 50-to-1 leverage. Once again, if we're looking at this on a big standard lot of 100,000 units or $100,000, it only takes 2%. Now, what does that mean? Let's take a home, for example. Let's just say the home is worth $100,000 and you're putting 5% down when they had the 5% down. So maybe 5 or 10%. The market house, if the home moves from 100,000 to 110,000, you've only put 10% down. What that means is that the market's moved $10,000 based on the $100,000 notional amount, where you've only put 10,000. So essentially, if you bought real estate at 10% down and the homes moved 10%, you've made 100% on your money. That's exciting. Now, there's a futures side to the spot market, to the Forex markets, and we'll discuss the futures in a minute. And this has a 250 to 1 leverage. What does a Forex chart look like? Well, basically, this is a Forex chart. It's the EUR-USD. And charts essentially are showing you the historical pricing. And the reason we look at charts is we look at patterns. We look at highs and lows of the market to determine when to buy or sell. If we feel the market has hit a low and we want to buy it and it moves up 100 pips, well, at $10 a pip, you can imagine the value or the profits, the potential that this offers us. So we look at charts and we look at them between the different currency pairs and the different currency crosses. Let's talk about futures. A little introduction. The futures are a derivative of an underlying asset, stocks, bonds, Forex, and commodities. Well, what are commodities? The commodity markets are wheat and corn and coffee and cocoa and soybeans. Have you ever went to a Japanese restaurant and had edamame? Those little green things? Those are soybeans. We actually trade that. Well, I don't particularly trade it, but it's tradable in the exchanges. Gold and silver and gas and oil. If you ever wonder what's happening with gas and oil, we look at the charts every single day and we look at patterns, and it's amazing that the gas prices at the tank reflect what we look at on our charts. And of course, sugar. Sugar is actually traded as a commodity. Now, Forex also, what we just looked at in the spot Forex market, that has a futures attached to it also. What we look at is the S&P 500 futures, the Dow futures, and the NASDAQ. We specifically trade the S&P 500 futures. We actually trade the Forex futures only. And let's take a little bit further look at the futures. The futures are, look at that little typo. The futures are traded at exchanges. The Chicago Mercantile or the COMEX or the Chicago Board of Trade or the NYMEX. What do we do? What do we trade? We trade the S&P 500 E-mini futures. And I'm going to explain that a little bit more in detail as we proceed. This market is open 23 hours per day, 5 days a week. It closes for 1 hour. So unlike the Forex market, where it's 24 hours a day, this closes only 1 hour per day. What is the S&P E-mini futures? It's a derivative of the entire S&P market index, which is a barometer of how the stock market is doing. Have you ever heard somebody say, hey, the market was up today or the market was down? Well, they're talking about the S&P 500. It's a collection of 500 or a basket of 500 of the leading U.S. stocks. And it was inception in 1957. And the futures, which are a derivative and an index since 1982. This has a $5 trillion market cap. It's huge, massive. Similar to where you have the Forex market, that's a massive market. This is based on 500 big stocks, and I'm going to get to that next. It's extremely liquid to trade. It's extremely favored by traders. Day traders love it. Swing traders love it. Everybody loves trading the S&P E-mini futures. Now, the futures are leveraged products requiring a small percentage of the cost as margin to trade. And we're going to show you a chart in a moment, but the S&P E-mini futures contract value is 50 times the value of the index. Example, the market index at this particular time is at 2,000 at the time of this taping. So the $2,000 value of the market multiplied by $50 gives us $100,000 for the value of one E-mini contract, or what we call one position. So leveraging is amazing. The margin requirement to trade the day session can be as low, or actually 23 hours a day, can be as low as $500 or $400. So we have nearly 200 to 250 to 1 leverage. That means for every $5,000, you multiply that by 250. Wow, that's a lot of money. Let's take a look at a chart and let's discuss what is the S&P 500 index again. If we look up here, the list of S&P stocks that make up the S&P cash index is on the left. Stocks that you've heard of: Priceline, Apple, Google, Amazon, Visa. How about the Wynn Resorts in Vegas? Yes. Goldman Sachs, Ralph Lauren. These are stocks you've heard of, and together makes a $5 trillion market value. So what they did was the exchange was created this S&P index, and as you see, here's a chart of it at the time of this taping. It was around 1920. So we look here, and the value of the cash index was created, and they have a futures index. So that allows us to trade the index or all of these stocks as a basket for a small down payment. Could you imagine trying to trade the entire stock market? How much money do you need? Well, we really only need $400 to $500 at a minimum to control around $100,000. Now, as a small disclaimer, we don't suggest putting $400. We suggest putting several times that amount, and we can explain that more in the future should you decide to get more information. However, let's talk about pricing and how it moves in terms of the profit potential. The market is, in this example, a value of 1922, as we explained earlier, was around 2000. This chart was a little bit older, but you're nearly controlling a 200 to 250 to 1 leverage. Every time the market ticks, that's this little 50% sign and little 50 cents, a little zero, it goes 0.25, 0.50, 0.75, and then 00. And each time it ticks is $12.50 for every position that we control. 4 ticks equal 1 point, and the average range per day is 20 points. So $50 times 20 points is $1,000 in trading throughout the course of a trading day. It's amazing. We're not investing, we're trading, and we're looking for little opportunities. The advantages of trading versus investing in the S&P E-mini futures or Forex: traders can take advantage of the trading line, whereas an investor can only buy and hold. What does that mean? Well, an investor has to buy at one price and hope it goes up. A trader can hope it goes up, can hope it goes down. We make money if the market goes up or if the market goes down. And what is a trading line? Each day the market has swings, as I said, both up and down, and it creates a line. And this line provides opportunity for traders to participate in. In the following slides, you're going to see the S&P and the Forex markets. And we're going to discuss this more in detail as we proceed. Here's an example of the futures market, the S&P futures, where the market goes up and down. But let's say it goes during the beginning of a day, it goes from here up 17 points and down 12 points and up 9 points and down 5 points and up 6 points. So you have 17 plus 12 is 29 plus 9 is 38 plus 5 is 43 plus 6 is 49. All right, we'll do that one more time. 17 and 12 is 29, 38, 43, 49. So as you see here, let's just use a round number of 40 points. Let's just say 20 points in a day, as I said earlier. So let's just say the market only made a move up or just made a little move here. The point is, as an investor, the market went from 1746 to 1762, and the investor has to hope it continues to go up. A trader can buy this or sell this or buy this or sell this or buy it. We can determine up or down if we want to profit. If we feel the market's going to go down, we could what they call sell short. That means we take a position on a sell. And if the market goes down, we earn a profit. That's exciting to think about it. All this opportunity that the markets allow us on a day-to-day basis. In the Forex market, it's the same principle. On a standard contract, if you look at this, at $10 per pip, you could do the math. Up 55, down 63, up 50, down 90, up 30, down 30. And this is in the course of one day. Now imagine you're looking at this on a mini contract or a micro contract. The point is the Forex market is the most volatile market in the world. And this provides an amazing amount of opportunity to trade. Now we trade this both on the spot market, which is the 2% or 50 times leverage, or we trade this in the futures market, where basically we're leveraging nearly 200 to 250 times our money. So there's multiple opportunities to participate both in the Forex, the futures, and the Forex for futures. The advantages of trading Forex and S&P E-mini futures or the Forex futures is market liquidity. This is the ability to execute orders of any size and efficiency. And yes, you can get in and out at a blink of an eye. If you want to buy or sell immediately, the market will allow you to do that. The volatility means a measurement of the amount of speed which prices move up or down in a particular market. Both the S&P E-mini futures and the Forex futures provide a high level of volatility to enter and exit trades, and traders love volatility. So the advantages are both liquidity, volatility, and the next one is affordability. What's amazing is imagine you can buy a home, to $100,000 home, and control that home for less than $1,000, $500, $2,000, $3,000, $5,000. That's what we do in the markets. We control large assets for a fraction, for pennies on the dollar. As I mentioned in the prior slides, a trader can trade both the futures and Forex markets for a fraction of the market value due to the low margin costs and high leverage. How do we do it? Now, what we're going to do from this point is go through a pattern, as I discussed earlier. And that pattern is one of the most highest probability patterns in the industry for decades. So let's look. We use technical analysis, and this is the foundation of our charting and trading analysis. We do not look at news. We do not look at the insides of a company. We use pure technical analysis, which is the study of price movement. So the charts, as we looked at earlier, reflect the history, and it highlights patterns that we use to identify for buying sell opportunities. We trade high probability, repeatable patterns with the highest odds for success. Now, before we go further, I just want to explain a little bit about what iMarkets Live does, what we do, how we help others, and how does it benefit you. And then we're going to continue to discuss that particular pattern. We provide educational services at iMarkets Live. You could watch us live in a virtual trading and educational room, essentially looking over our shoulder during the course of an 8-hour day. We provide education on trends, on patterns, on technical analysis for both the futures and the Forex markets. We keep it engaging throughout the day, and we educate traders to be successful in the industry. If you have the time to learn, to earn, to be excited, to sit in front of a computer and just watch as patterns unfold and we track these patterns, then this is for you to get more information on. The other key product we have over at iMarkets Live is our hands-free signal service. What does that mean? That means that you work 1 to 2 minutes per day and you turn on the signal, whether you have a live account or a demo account. You start with the demo and you can always go live with real money. That's purely up to the individual. But we allow those of you who can't sit in front of a computer all day to plug in and get the same ideas, the same trading opportunities that our live trading educational room gets. So if we feel the market is a buy or a sell, we send a strategy signal, and that strategy signal goes around the world in less than a fraction of a fraction of a fraction of a second. And those who are connected to our server, to our app, which is a very simple app that takes literally 2 minutes to install. Those who are connected get the same trade. So you could be on an airplane, you could lay on the beach, you could be sleeping, and our traders, we may see a pattern at 3 o'clock in the morning, and when we trade, you get the same trade hands-free. Get more information on that. And we also have a trade alert, a self-managed signal that hits the email each and every day, and those are for the traders who want to do their own trades, but yet get ideas from us. So if we see that the GBP USD is a buy, we send a signal out through an alert. It hits your email, and we give the zone when to buy, when to sell, where's your target, where's your risk point. It's exciting, and we have a variety of different types of webinars that we provide on a day-to-day basis. Let's get forward. Let's get going. Okay, in the series of charts, we will draw out the Gartley pattern. This uses specific criteria using what we call Fibonacci ratios, and that determines the bullish or bearish patterns and turning points. The Gartley pattern was outlined in his book, which is H.M. Gartley, Profits in the Stock Market. In a 1935 book, he had put a pattern in there, and it has since evolved to modern day trading where we look at this particular pattern that has stood the test of time for decades and decades and decades. Fibonacci ratios date back thousands of years and are specific numbers and sequences and ratio that had stood the test of time. We call this phi, P-H-I, and if you want to learn more information about it, you can actually Google it, P-H-I. You can Google Fibonacci, an Italian mathematician who wrote a book about Fibonacci sequences, the Great Pyramids of Giza, natural occurrences in your body and in plant life, in nature, in the stars, in the universe, all revolve around these relationships. So it's no wonder why it's become a major, major factor when looking at trading and in the stock market. The Investopedia has a definition of a Gartley pattern. So the pattern that we're going to show you, that we're going to share, is a legitimate pattern that has specific ratios, that is an extremely high pattern that we use day in and day out and that we teach. It's one of many patterns that we use, but we're giving you one example because you took the time to sit in front of the computer. You took the time at this webinar, and we feel it's our duty to share with you value and what you can expect by working with our company. The Gartley pattern. Now, this is a blank canvas, a blank chart of the USD JPY, and a chart to a trader is like a painting to an artist. Trading is part art and part science. We look at this chart and we look at highs and lows. We look at this as a trader and we look at all these little swings and we determine what patterns are sticking out for us. Where would we buy or sell and why? And in this next chart, you can see the USD JPY, or the Japanese yen, and we identify the past history to determine what the market can do in the future. We identify the market's swing highs and swing lows to look for patterns. And I have noted off all these little highs and lows that we look at. So if you're a beginning trader, if you're somebody who's looking to learn technical analysis, you want to look at these highs and lows. That's the foundation of what we look at in the markets. Now the Gartley pattern, as we discussed. And if I'm going too fast, you can always slow down and rewind the video. The Gartley pattern. Series of swings and data points with specific strict criteria, or what we also called an X, A, B, C, D pattern. And from X to A to D, and I'm going to teach you how we look at this. X to A to D. So X is the low, A is your high, and then we have what we call that retracement from A to D, and that's a 8.6, a specific criteria that is required for the Gartley pattern. We look at this pattern. We're not going to get into other details, but this is the first criteria we look at. The second criteria we look at is the XA to B. What does that mean? Well, the X is the low, the A is the high, and the B is that pullback. That is a 618 retracement. And that's part of that specific criteria that we look at. The next two things we look at, the first one is the A to B minus C. What does that mean? Well, A is your high, B is your low, and up, C has to be between 38 to 88% of that A to B swing. So if A was 0 and B was 10, it would have to come between 3 and 8 points back up. Simple. And then we have the B to C criteria. This B low to C high, then down to D, has to have a 1272 to 1618 extension. Now don't worry about all this math right now. I'm just showing you a particular pattern and how we look at it as traders. What's exciting for those who sit in front of our educational service throughout the course of the day, every single day, or those who attend our webinars, they learn how to do this on their own. They take the time and they can learn at their own pace. Those who are on our signal service, and quite honestly, we have people in our live education room who use the signal service, because when we buy or sell and we send a strategy signal, maybe the person learning doesn't want to do the execution. They just want to see how it's done. Or the person's on the airplane or at their job or sleeping. When we buy or sell and we send our signal, they get the same trade. They don't have to learn all this mathematics. They don't have to learn all this detail. So it's the best of both worlds. For the person who wants to get educated or the person that doesn't want to get educated but yet participate in what we do. And this is what we look at. So the Gartley pattern. Here's your X, A, B, C, D pattern. Let's go to the next page. We start to look at these swings again. Series of swings and data points, each with strict criteria, and I drew them in. The X to A down to D. The X to A down to B. As you recall, we looked at these retracement levels. So those of you that are learning or want to learn, that's considered a retracement. X to A retraces to 618 or retraces to a 786 area. You can see this. The next chart, and we only have two charts left, so stick with me. The next chart, we look at the B to C down to D extension. So B up to C extends down to D, and we look at this extension area. And that's that 1618. And as you see, it combines. Here it is. I'm sorry. Last chart, or we have one more chart, one more page. The Gartley pattern, the series of swings and data points, each with that strict criteria, that X, A, B, C, D pattern. And here is that exact criteria that we discussed. You could do all the research on the internet. You could look at YouTube. You could look all over the place, and there's a lot of data, a lot of information on this particular pattern. We have a couple of key ingredients that we also use that we've added to our service, which reduces the risk, lowers the losses, and increases the probability of success. Now let's just take a look at this chart right here. It went from 97 to 98.2, nearly 1,200 points it moved. That's huge. Well, if we look at this on a standard contract at $10 per pip, points pip, that's nearly $1,200. If we look at this on a smaller level, the mini level, it's $100 to $120 in movement. So anybody from any size, you can trade a half a standard, a couple of minis, a half a mini, whatever you like. That's the beauty of the markets. But the pattern itself is powerful. This is on any time frame, any market, whether it's a commodity, a future, a Forex, stocks, anything. This is an amazing pattern. This is what we do at iMarkets Live. This is one of the many, many things we use to be successful. And in this last video, this actually right here is what you're looking at is my workstation. I actually have two additional screens that are 27 inches wide with two other computers attached to it. This is 8 screens, not big, large screens that I look at through the course of the day, that our traders look at, and we're educating. And we share our, right down here on the bottom left, you're going to see a screen, and I have 6 different charts. That's actually the screen that we share live to our members day in and day out. And if we see an idea, an opportunity, maybe on another chart, we put it there, or we move our video from chart to chart to chart all around. So our members who want to learn and earn and get in-depth training every single day can watch exactly what we're looking at. So while I'm looking at 8 charts, 8 screens, our traders only have to look at one. And those are the ones on the educational side when we do webinars. And again, those on the signal services, they don't have to worry about this. They can just click the button, work a minute a day, and they can have their beauty sleep. Now, if you're looking at this webinar and you're interested and exciting as I am, and as the thousands and thousands of people from iMarkets Live are throughout the planet, we are in nearly 62 countries. We have people from around the globe excited about this charting, about what we do, about our signals, about our education. And if you want to get more information, just contact the person who introduced this video to you so you can get more information, or you might offer to you, if you would like, take a 14-day test drive to our services. Take a 14-day test drive, a $1,500 product for 14 days. Ask the person who invited you to take that 14-day test drive of our services. And if there's a button below, depending on what video page you're looking at, take the one that says take a trial to our 14-day services. However you do it, welcome to iMarkets Live. My name is Christopher Terry, and I want to thank you for spending your time, your valuable time of watching what we do in the markets and learning how we create profit and sustainable wealth for the future. This is something that you could take for the rest of your life and become a success. You never, ever, ever have to worry about another individual controlling your time, your money. Good luck and welcome to iMarkets Live.